Good morning everyone and welcome to this Primary Markets webinar for MPG and in particular their Retail Brands Property Fund. Today we're hosting Brett Gorman, who's CEO of MPG, who's going to provide further information about the offer. So without further ado, I'll hand over to Brett and we're underway. Brett, thank you.
Well, thank you, Nick, for that warm introduction, and I'd also like to extend that warm introduction to the investors listening out there today. I'd like to talk today about, I guess, the benefits of unlisted property, but also introduce you to the MPG Retail Brands Property Trust, which is a trust that we manage. As you see, there's been a lot in the press recently about pending changes to superannuation rules and also clampdowns in lending to self-managed super funds there as well. So on that basis, investors have been looking for alternatives, and unlisted property trusts have been providing a relatively high yield type arrangement that a tax advantage with low volatility compared to other share market and other investments. It also removes the headache, I guess, of ongoing property management there as well. So the MPG Retail Brands Property Trust, so it's an unlisted property trust that has a diversified portfolio of 12 quality retail properties that includes brands that you know and love, such as Coles, Bunnings, Woolworths and Target. So the assets are predominantly neighbourhood shopping centres, but they also include some standalone stores and large format retail in them as well. So they're primarily located in the eastern seaboard states of Victoria, New South Wales and Queensland, but there's also a couple of smaller holdings in South Australia and Tasmania as well. Now, the trust, we're looking to raise about $10 million. We're looking to issue about 10 million ordinary units at $1 each to fund the acquisition of a new Queensland-based centre known as the Beaudesert Central Shopping Centre. So the investment has about 5 years remaining on the current term from 30 June this year, and we think that 5-year term offers investors the potential to benefit for capital growth over that time. As an exit sort of facility as well, there's also a limited liquidity arrangement from 2020 as well. It's got a relatively high cash forecast yield of 7.25%, which we think compares very favourably to current cash rates on offer, which is sort of around the circa 2% type range. The debt facility, we've recently extended it to March 2020, and it's fully hedged to mitigate the risk of any potential interest rate increases. So the minimum investment here we're looking for is only $10,000, so it's a very low entry point, but we do sort of note the average investment for investors is probably around that $75,000 to $80,000 type level, but no, we do accept applications from $10,000. So in terms of, I guess, the capital, we're looking to fund the purchase of the Beaudesert Central Shopping Centre, which is a new Woolworths-anchored supermarket centre with 12 specialty tenants, which is located about an hour's drive from Brisbane and the Gold Coast. It's in a growing area. We like it because it's got potentially good population growth with a sort of mooted about just over 4% population growth, which is higher than the Queensland average of about 2.21%. So with that comes infrastructure improvements and all that sort of thing down the track as well. So we like the area because of the demographics. Some of the specialty tenants include Subway, QML Pathology, Specsavers and Sol Patterson Chemist. So it also offers us other means to add value through our active property management, I guess, activities. So as an example, the Rocks Shopping Fair, which is one we bought recently last year, and it's located on the New South Wales Central Coast. So as part of, I guess, the value-added type strategies that we've done, we looked to change the name. It was a pretty dag. It was Rocks Shopping Fair. We changed it to a more modern name, the Rocks Central. We updated the website. We've improved the tenancy mix with a view to optimising all the rents, and we're now looking at ways to, I guess, modernise and the internal food court and moving supermarket trolley bays to improve the flow of traffic and give the centre, I guess, a fresh repaint as well. We're also looking to engage the local community and marketing to a large number of tourists to increase the patronage of the area. So that's just an example of some of the value-add type things that we can do to improve the value of the property. In terms of unlisted property trusts, there are a number of ways that you can benefit, but there's probably 3 ways which I'll probably highlight today. So the cash returns, number one, are very high compared to the current cash rates on offer. It also, because of the tax deferred nature of the investment, your tax bill can be deferred on the distributions, and it also removes the hassle from property investment there as well. So looking at the cash yield, you know, the RBA rate's currently around that sort of 1.5%, which is barely sort of keeping up with inflation at the moment. Most cash fixed term deposit rates are around that 2% type range. So there's probably a 5% premium for an unlisted property trust at 7.25%, which looks, you know, to be quite attractive. And even with the listed property trusts on the market at the moment, sort of yielding around that sort of 5% range, it still offers a, you know, what, 2 or 3% premium to those as well. So it's a very high return compared to other products on the market. And I guess that average, you know, that regular income really suits those retirees looking for regular income, and also self-managed super fund and high net worth type investors as well. In terms of the tax-deferred nature, because of the special building write-offs and depreciation allowances, a lot of the income is tax-deferred. So as an example, using this chart, an investor on the top marginal rate of 47% is earning over $180,000, would need to achieve a yield on about 12.26% on a cash or a product that doesn't have that same tax effectiveness. So that the tax benefits, you know, are really, really promoted there. And even looking at a super fund in accumulation phase, you know, paying the 15% tax, you'd have to earn about 8.25% on equivalent investments to make that work. So that again, this really benefits the high net worth investors who want the income but don't want to have to pay the tax, and also the self-managed super funds in the accumulation type phase who'd like to enjoy the income but not liable to the requisite taxables that will be payable under a non-tax effective investment environment. And I guess the third major advantage is we sort of take away all the hassle of property investment. So you don't have to deal with the tenants, you don't have to worry about the physical payment of bills, you don't have to organise repairs or deal with, I guess, you know, the banks there as well. So we've got over 40 years experience in property and investment markets, and we can use that experience to maximise the value of the property. And in terms of, I guess, the paperwork now, it's very simple. You see that basically a quarterly distribution statement and trust updates with how all the properties are going, and also an annual tax statement which can easily be incorporated into your annual taxation return. So this should take away a lot of the hassle and make property investing a bit easier for you as well. In terms of the properties in the trust, so there's exposure to 12 properties with a value of circa $100 million, and on settlement of the Bowes Desert Central Shopping Centre, there'll be about 4 neighbourhood shopping centres, 4 standalone supermarkets and hardware premises, and 3 large format retail centres. And all the properties are anchored by names that you know and trust, such as Coles, Bunnings, Woolworths, Target, but it also includes a bit more diversification with over 60 smaller complementary specialty tenants in there as well, such as hairdressers, pharmacists, cafes and that sort of thing as well. So it's quite the risk is quite spread. So in terms, I guess, the actual properties in the trust, as an example, so the Village Lakeside Shopping Centre, which is the first picture you can see on the left screen there, is located in a Delphin housing estate, so it's a fully integrated estate, a master plan community located about 55 kilometres southeast of Melbourne. So it's anchored by a very strongly performing Coles who are exceeding all expectation, and also includes 10 specialty stores such as Cold Rock Ice Cream, Brumby's Bakeries and Advantage Pharmacy as well. The Rock Central Shopping Centre is located on the New South Wales Central Coast, which is the top right-hand picture in your screen there. Anchored by a Coles supermarket, also includes 14 specialties including Liquorland, the Reject Shop and Blooms, the chemist. Home Central Warrnambool, which is the bottom right of your screen, is located in Western Victoria on the coast, and anchored by a Bunnings Warehouse, which have just extended their lease by a further 7 years recently. Also includes Amart All Sports, Petstock and 40 Winks in there as well. And Coles Moxvale, which is the bottom left-hand corner of your screen, is a standalone Coles supermarket, which we purchased last year and is located probably between Sydney and Canberra in New South Wales there as well. Target Kadina, which is located in the Copper Coast, which is north of Adelaide, and is part of the ASX-listed Wesfarmers Group. And the Seaford Meadows Shopping Centre is a neighbourhood shopping centre located in South Australia and anchored by a Woolworths and 14 specialty tenants, and held an investment in the MPG Seaford Meadows Property Trust. The Churnside and Mildura Homemaker Centres are large format retail centres held by the MPG Bulky Goods Retail Trust, and have tenants including JB Hi-Fi, The Good Guys, Fantastic Furniture, Chemist Warehouse and Amart All Sports, amongst others. In terms of the key property details, we're trying to get a bit of geographical diversification, trying to get mainly up the eastern seaboard coast. So we have exposure to about 50% currently in Victoria, 24% in New South Wales, 16% in Queensland and 10% between South Australia and Tasmania. So it provides a good level of geographical diversification. Ideally, down the track, we'd like to get 30% Victoria, New South Wales and Queensland and 10% with the other states in there as well. So that's our aim going forward. The major lease exposure there is to Coles with 20% of the total rental income of the trust, followed by Bunnings with about 13%, Woolworths 12% and Target 8%. So this ensures that there's no major reliance on any single type tenant, and there's a very good sort of balanced sort of tenancy mix there as well. It also has a long-term weighted average lease expiry of 6.7 years by gross income. And it should be noted that 65% of these leases expire after 2024. So this provides a good security over the cash flow of the underlying income streams and returns to investors there as well. In terms of the key risk mitigation strategies, so we're very active and we look at all the risks quite actively and try and identify what they are. We're very risk adverse. So we do this by choosing quality tenants such as the Coles, the Woolworths, the Bunnings as anchor tenants to diversify the risk. Before we purchase any property, we undertake thorough building, environmental, legal and financial due diligence just to ensure that, the building is structurally sound to reduce the potential for any future property risks and any defects going forward. We also very actively manage the debt to ensure the loans remain in compliance with all the banking covenants and interest is sufficiently hedged to guard against any interest rate increases on that time. So you can see we've sort of covered off most of those major risks and we're very active in making sure those risks are covered off going forward as well. In terms of the cost structure, we've got a very simple fee structure. So we charge a sort of a once-off establishment fee of 2%, which is payable by the trust on the acquisition of each property. We have an ongoing management fee of 0.55% of the trust's gross asset. So this is charged on an annual basis on the trust's gross assets, and an end fee of about 2% on the sale of each asset in the event that the sale price is in excess of the total purchase price. So if it goes below that, we don't actually get any sort of end fee on that as well on that property. We're also entitled to a debt arrangement fee of up to 1% of the value of the debt, but we typically charge about 0.2% for any loan refinancing and any sort of new debt that's sort of coming through. So according to, the PIR property investment research report that we've had done on the fund, these fees are probably in line with our competitors and probably at the lower end of those sort of spectrum that they've sort of looked at as well. In terms of the investment structure, it's a very simple ASIC managed registered scheme, simple unit trust with MPG funds management acting as the responsible entity. So all assets are held by an independent custodian, being the trust company, which is a subsidiary of the ASX listed Perpetual Limited. So that's an investor protection measure, just to ensure that the ownership of those investments are held externally. So investors basically just invest in units in the trust, and the major bank holds the first mortgage security over the assets of the trust on a non-recourse basis. And this is very important because it means in the event of any default of any bank debt, investors won't have to pay any more than their contributed equity amount, so the banks can't go after us for any other assets that we've got. So you just limit it to that additional equity amount in that unlikely event. In terms of who we are, so MPG Funds Management, we've been around for about sort of 15 years. When we're part of the McMullen Group, who's sort of been in operation for over 40 years. So McMullen Group is a large family office which generated most of its wealth from the establishment of the ASX listed Spotless Group, which is now under takeover from another provider as well. So MPGs are licensed by ASIC, and we have over sort of 10 or 11 other property trusts with funds under management of over 400 million. So we've got pretty good experience on that sort of level. We've won a couple of awards, as you can see on the left-hand side of the screen there as well. In terms of the key personnel, it's sort of led by Executive Chairman Trevor Gorman, who's a chartered accountant and former partner of Deloitte, who's over 30 years of property development and investment experience. Non-executive director Eddie Paulson, who's a former executive of National Mutual AXA with 40 years property investment experience. Ian McMullen, who's a senior executive of ASX listed Spotless Group, and myself, Brett Gorman, who's a chartered accountant and licensed real estate agent there as well. So in terms of this trust, we think it ticks a lot of the boxes. So it received an A rating from independent research house Property Investment Research, which has reviewed our funds and gone through all their stringent process to ensure that it's investment grade. It pays a very attractive return of 7.25%, which is higher than most of the cash rates on offer, which would appeal to retirees, self-managed super funds and high net worth investors there as well. And there's a long-term weighted average lease expiry of over 6.7 years to ensure security of the underlying cash flows. So MPG also is an experienced manager with also over 40 years experience in property investment and management. And I guess the other kicker is we co-invest in all these trusts to ensure that we're looking after your interests as well as ours as well. So we think it ticks all the boxes and it's a very good type investment. So I guess looking at the next steps, if you want some further information, you can click onto our website at mpgfm.com.au or contact at PrimaryMarkets there as well. I'm also available personally to take any email requests, so you can email me at bgorman@mpgfm.com.au. But look, we look forward to hearing with you, and we look forward to welcoming you as an investor in the MPG Retail Brands Property Trust.
Fantastic. Thanks very much for that, Brett. Really comprehensive overview of the offering. And we appreciate your time today to take us through the story. So without any further ado, I'd just like to sign off and say thanks to Brett, thanks to MPG. Again, you can obviously go to the website to get more information. This presentation is available, and some other documents obviously regarding the investment are available either through the website or through Primary Markets, and we look forward to hearing from investors shortly. So on that note, have a great day and thanks very much.